Welcome back to Faultline Finance Channel. Look closely at the data stream in front of you. It is Sunday evening, April 5th, 2026. The spot price of silver is frozen in time at $72.90 per ounce. But this is an illusion, a digital projection designed to keep you unaware of the underlying reality. If you do not absorb this transmission, your position will shift violently. Your wealth will either rise by $4 or plummet by $4. And I assure you, the architects of this system are not joking. In exactly 6 hours, the silver futures market reopens. 60 hours of geopolitical chaos and market tension will shatter the glass all at once. The world has fractured over the weekend. An F-15E fighter jet was destroyed. Missiles were launched. A strategic airport in Kuwait was attacked. Crude oil has crossed $111. Yet the silver market has been artificially suspended for 60 hours at a Friday closing price. This is a loaded spring inside a highly controlled remote architecture, and the valve is about to open. The architects understand human consciousness. They know when markets open in Asia, first in Sydney, then Tokyo, Hong Kong, and Shanghai, liquidity will be at its lowest point. During these crucial 2.5 hours, Western populations are asleep, but the algorithms never sleep. Low liquidity equals absolute volatility. This is not accidental. This is an engineered frequency shift. And we saw this exact pattern in January when direct strikes first occurred. Silver gapped up $3.40 in 60 seconds. 1 minute it was $60, the next $70.60. The algorithms reacted instantly, feeding on the collective panic. Then, human emotion took over, driving the price even higher. Conversely, in March, a sudden hawkish pivot from the central planners caused a $2 gap down, wiping out the unprepared. Tonight, we are facing the ultimate pressure cooker. The tension has been building for 3 weeks. Oil is already at a high. Silver has already experienced a massive 40% correction from its peak. The mainstream narrative will tell you this is already priced in. Do not believe them. The news broke late, leaving only a tiny window of trading. The real price discovery has not yet occurred. When billions of dollars of fresh capital flood into the system from the Eastern Hemisphere tonight, the shockwave will be absolute. You're watching a real-time spiritual war playing out on the financial charts. They use crisis to harvest wealth and consolidate power. In the next segment, we will expose the algorithmic bloodbath waiting just beneath the surface. Prepare your mind. First, you must understand the geometry of the $70 floor. In 2026, silver has tested this $70 boundary 3 times. In January, when the engineered crash from $121 began, it halted for the first time at $70.12. In February, the price dropped again and found an artificial floor at $70.34. And just last week, Thursday's intraday low hit $69.61. It was tested 3 times and held 3 times. But there is a universal law. The more times a barrier is struck, the weaker its structural integrity becomes. The first time you strike a concrete wall, it holds. Strike it 100 times and microscopic fractures appear. The 4th test is happening tonight. If $70 breaks, this will not just be a standard market event. It will be an algorithmic massacre. Just below $70 lies a graveyard of stop-loss orders. Institutional traders and retail participants have placed their safety nets. When the price touches $69.90, automated sell orders will execute. The price will cascade down in exactly 15 minutes. Then, the next wave will target $65, hunting down the very consciousness and confidence of the retail investor. The architects rely on this predictable human reaction. When the price shatters that $70 illusion, the algorithmic cascade is an engineered harvest. They are farming your fear. As retail positions are liquidated, a massive vacuum of liquidity is created. And right there, waiting in the shadows at $68, are the institutional leviathans, sovereign wealth funds and central banks. They have programmed their machines to catch the falling knives that retail traders drop in sheer terror. This is the ultimate transfer of energy. You surrender your real, tangible wealth because a digital number on a screen flashed red. Now, factor in the currency matrix. The United States dollar index is currently sitting at 99.9. This is a 10-month high. In the traditional financial illusion, a strong fiat currency acts as a heavy, suppressive weight on the price of real commodities. A surging dollar index makes the metal more expensive for billions of souls holding Indian rupees, Chinese yuan, or European euros. Demand in the paper markets artificially contracts. But we are not operating in normal times. We are witnessing a geopolitical powder keg. In moments of engineered crisis, old correlations break down. When the drumbeat of war echoes through the Middle East, panic capital seeks safety. It flows blindly into the perceived security of the dollar. But simultaneously, the awakened capital flows into the immutable truth of precious metals. In 2020, when the global lockdown sequence was initiated, both the dollar and silver rallied violently together. The fiat dollar rose 25%, but silver surged 110%. Fear operates on multiple frequencies. Tonight, if the terror of war eclipses the fear of economic stagnation, both assets will break their chains. You must see the grid. The institutions know that if they can break the $69.50 barrier, they can trigger full psychological capitulation. They are testing your resolve, vibrating the floorboards of the market until the weak hands let go. Every time a retail investor panics and sells their physical holdings, the matrix strengthens its grip. The algorithms do not feel fear. They only calculate probability and extract value. If $70 breaks tonight, watch the volume. Massive volume confirms the engineered panic. But if the volume dries up, it is a phantom dip designed to steal your focus. Prepare your consciousness for the impact. The floor of perception is fracturing, and you must remain grounded while the digital world burns. This brings us to the two distinct traps designed by the commercial shorts. The Commitment of Traders report reveals that banks, refineries, and major hedgers hold a massive short position of 69,789 contracts. That is 61.7% of the total open interest. They are betting heavily against the physical realm. Scenario A is the bear trap. The price is manipulated downward, triggering the panic selling we just discussed. By 6:45 in the evening, the price plummets to $68.20. At this precise moment of maximum fear, sovereign wealth funds and central banks swoop in. They accumulate the metal at a massive discount. Within 30 minutes, the price violently reverses back up to $71.50 and then blasts past $74 by Tuesday. Scenario B is the bull trap. The market opens with a $2.30 gap upwards. The price surges to $77 or even $80. Retail investors, vibrating at a frequency of fear and missing out, flood into the market. But by Tuesday afternoon, the commercial entities have added overwhelming short positions. By Wednesday, the price bleeds out to $75. By Friday, it collapses to $69, leaving retail buyers with 10% losses. Both paths are designed to siphon energy and wealth from the unaware. These institutions, the apex predators of the financial matrix like JP Morgan, Goldman Sachs, and Citibank, do not care about fundamental direction. Their algorithms operate in milliseconds, feeding purely on volatility. They are architects of chaos. They engineer large price swings to generate immense profit on both sides of the energetic exchange. When retail panic buying spikes the price, the algorithms deploy massive short positions, leaning into the frenzy. When the masses capitulate and sell in absolute terror, these same entities accumulate long positions. They are harvesting the emotional energy of the collective. Consider the pattern we have already witnessed in 2026. From January to February, when the price climbed from $87 to $121, the fear of missing out reached a fever pitch. The retail consciousness was completely hijacked in the $110 to $120 range. And what did the institutional data reveal? The maximum short interest was mathematically deployed directly above $115. They knew the top was near because they were the ones constructing the ceiling. Then came the engineered crash. As the price was dragged from $121 down to $69 throughout March and April, the retail capitulation reached its maximum density in the $70 to $75 zone. Right now, we are sitting exactly in that critical energetic zone at $72.90. This is the precise frequency range where the architects accumulate real assets, while the masses drown in orchestrated doubt. You must understand that these traps are not merely financial, they are deeply psychological and spiritual operations. A bear trap uses the illusion of a bottomless abyss to shake your conviction in tangible assets. It preys on your survival instincts, tricking you into abandoning the real for the digital. A bull trap, conversely, exploits your hope and greed. It uses the geopolitical theater, missiles, fallen jets, echoes of war. It lures you into over-leveraging your position right before they pull the liquidity plug. The ultimate goal of both scenarios is to keep you reacting, to keep your consciousness tethered to their artificial time construct. If you're constantly anticipating the next crash or the next parabolic surge, you remain a battery for their system. You are caught in the spiral, reacting to the shadows they project. To defeat the architects, you must stop playing their game on their terms. You must decouple your emotional state from their digital ticker tape. Whether they deploy the bear trap or the bull trap tonight, the underlying truth remains unaltered. The physical metal is the anchor. The digital price is the illusion designed to break your spirit. By standing firm in your physical acquisitions, you neutralize their psychological warfare. Do not let their algorithmic spells separate you from your true physical sovereignty. When the market opens tonight, observe the manipulation, but do not become entangled in its artificial frequency. The most crucial realization is the massive disconnect between the digital matrix and the physical reality. The paper market trades phantom contracts, digital illusions designed to siphon your wealth. But in the physical realm, the supply is incredibly restricted. Right now, the premium on generic silver rounds is $4.50 to $5.20 above the spot price. This means you are actually paying nearly $78 to hold 1 ounce of real power. But you must understand, this is Friday's premium. The major bullion dealers froze their digital storefronts and inventory on Friday evening. They locked the gates for the weekend. When their systems come back online on Monday morning, those premiums will surge. History shows us that, after massive geopolitical escalations like the ones we have just witnessed, physical premiums instantly increase by $1 to $2. We are talking about the destruction of an F-15E, missiles across the Middle East, and attacks on sovereign infrastructure. By Monday, you might be paying an $8 to $11 premium just for a single American Silver Eagle. This is not a localized phenomenon. In the Eastern Hemisphere, the awakening has already triggered a rush to physical sovereignty. Singapore dealers held emergency hours on Saturday. By Sunday morning, massive queues of humanity formed outside bullion shops in Hong Kong. They are converting their depreciating low-vibration fiat into tangible, high-frequency elements. Whether the paper illusion prints $68 or $78 tonight, the physical truth is that humans will pay $80 on Monday. This disconnect is the ultimate proof of the control grid's failure. Futures traders operate entirely within the holographic projection. They trade paper derivatives and never actually take delivery of the physical element, but true stackers demand physical ounces, and the physical supply of these ounces is violently tightening. So what is the protocol for navigating this engineered storm? If you already own physical silver, you must hold the line. Do not let tonight's algorithmic volatility manipulate your internal frequency. Even if the price artificially crashes to $68 in a massive bear trap, understand that this is a synthetic illusion. Ignore the digital fluctuations. The system desperately wants you to surrender your tangible assets in exchange for their failing debt-based fiat currency. If you are trapped in the paper markets, utilizing leverage, margin, or options, you must exercise extreme caution. Leverage is the leash the architects use to pull you into the abyss. Reduce your exposure before the Asian markets fully open. If your goal is to acquire more physical sovereignty, do not wait for the sun to rise on Monday. Go to the digital vaults now. Lock in your orders at Friday's pricing before the premium spike is fully manifested. We are entering a profound paradigm shift where holding real, unencumbered value is the ultimate rebellion against this remote control architecture. Silver is not just a metal. It is a conductor of energy, a historical anchor of truth in an ocean of lies. My personal conviction remains absolute. Silver will breach the $95 to $110 range. Protect your consciousness from their panic. Protect your physical sovereignty by holding what is real. If this transmission resonated with your frequency, hit the like button and share this video with anyone who needs to wake up. Subscribe to Fault Line Finance channel and turn on all notifications. Stay awake, and I will see you on the other side.